The previous chapter, we learned income tax withholding, calculating the income tax based on the two methods, wage bracket method and the percentage method. Today, we learn FICA taxes and voluntary deductions. Does anyone know what FICA stands for? Federal Insurance Contributions Act. These are contributions to fund the Social Security and Medicare benefits. Social Security tax is known as OASDI. OA for old age, S for survivors, and DI for disability insurance. Initially, this tax was just for retirees, but has expanded to provide financial support to employees, survivors, and disabled employees. Both employers and employees contribute into this fund, which would then be drawn from to provide financial support to individuals starting at age 62. The rate began at 1%, and this was in 1937, around the time of the Great Depression when our president was Franklin Roosevelt. It has steadily increased to what is now 6.2%. So for every $100 of taxable wage, one must pay $6.20 into the Social Security Tax Fund. Social Security wage base. When the wage reaches a threshold limit, any amount of year-to-date taxable wage earnings exceeding this limit will not be subject to Social Security tax. In 2018, the limit was $128,400, which was 2.8% increase from 2018-2019. The wage base limit has increased pretty much every year. In the year 2020, the cap limit will increase to $137,700, which would be 3.6% increase. What does this limit really mean? It means that those that earn very high level of income have a cap on what they pay into this tax. Then do you think there should be a limit? That's a point to think about. Another point to think about is supposedly the Social Security Tax Fund will run out of money in the year 2035. And what do you think of that? First, why would the fund run out? It's due to demographic change, the aging population. There will be fewer children and people are living longer. There is a risk that the system will run short of money since less will be paid in than is paid out. So the question is, what can be done to resolve this issue? Some of the ideas are to increase the tax rate, increase the limit so that the rich would not have a cap on what they must pay in, increase the age when one would start collecting benefits, or should we reduce the benefits so that the fund will be sufficient for people? Taxable earnings for Social Security tax. To calculate the Social Security tax, we must know the gross pay that's taxable for Social Security. In other words, the gross pay that is subject to the Social Security tax. Cafeteria plans are not subject to Social Security tax, so any amounts contributed to the cafeteria plans are excluded or taken out of taxable pay for the Social Security. 401k are subject to Social Security tax, so we do not exclude the amount that is contributed to the 401k retirement plan. First, determine what is the taxable pay of the current pay period subject to Social Security tax, and we know from the previous slide it includes 401k contribution, but exclude cafeteria plan like the flexible spending account. Step 2. We want to know if the pay from the current pay period brings us over the Social Security tax wage-based threshold. We do that by determining our year-to-date earnings so that in step 3, we compare to the threshold. Year-to-date earnings is calculated by taking the current period earnings and adding it to the given prior year-to-date earnings. The next step, we compare current year-to-date earnings to the threshold. If year-to-date earnings is below the threshold, then all of the current period earnings in step 1 is subject to Social Security rate of 6.2%. If year-to-date earnings is higher than the threshold, then the amount that is higher must be subtracted to exclude from the current period earnings before applying the Social Security tax rate of 6.2%. When the amount that is higher than the threshold that is subtracted to exclude from the current period earnings results in a negative number, then this means that the Social Security tax is zero for this period, because the threshold was already exceeded in the prior period, hence no Social Security tax in the current pay period.